So that's what it comes from, is gilt edge. And the idea is they've got a kind of gold backing in some spurious sense. It's an old-fashioned term, means nothing now. It's just a traditional name. Bonds, long-term government bonds, sometimes called gilts. And the ones that are close to extinction are the top. Hello. So, Treasury 4%, 4.5%, 07 is a bond which is going to mature at some stage next year. If there is a specific date, and it isn't published here. Hello. You see the present price is £99.82. Okay? And it's going to mature sometime next year at a specified date, probably about 9 months or so, for £100. It's going to be redeemed at £100. It's also carrying a coupon of £4.50. And do you see the word red yield? Red yield is yield to redemption. And the yield to redemption is the average rate of interest, constant rate of interest over time, which gives a present value of the stream of dividends and repayment equal to the current market value. So you ask the computer to calculate that annualized rate of interest, which equates the discounted stream of interest and redemption to the present market price of $99.82. And the answer the computer comes up with is 5.01. 5.01 is a kind of average rate of interest over the period, which is a very short period, just probably a little bit less than a year. Now, change in yield over the day and the week, it's been steady over the day and the week, telling us something quite interesting. What this tells us, the fact that it's been steady over a day and a week, tells us this, reminds us that the capital value of a bond close to maturity is very close to 100 pounds, and very rarely changes much. So even if interest rates go up and down quite a bit, the market value is pretty sticky. Whereas that's not true of the bonds that are redeemed further into the future. So capital value is safer for a short-term bond, a bond soon to mature. Trust is going to be quite close to £100 and won't change much, even if interest rates vary. The longer it is away from maturity, the more risky the bond is in the sense of its capital value. Okay? That's a message you get from the two blanks, the two little dashes, and the day and week. It didn't change since yesterday. Yesterday is 31st of October 2006, and it didn't change over the week, the week from 25th October. But it did change over the month. But it's interesting to see that it changed rather little compared with a lot of the other bonds. Just 7p. That's all it did. It went up as compared with 1st of October by 7p. Not very much. Over the year, though, its capital value has gone up by 75p. Rather larger number. The high in the previous 52 weeks was £100.44. The low was 99.77. So very, very narrow band. Really narrow band. Compare that with the war loan at the bottom. War loan, do you remember the 2.5% William Pitt bonds, £2.10 which we had last week? Well, war loan is another kind of bond, similar one. It's irredeemable, and it was issued at the late stages of the First World War. It was converted, in fact, from an initial 5% coupon to 3.5% coupon by Neville Chamberlain, the Chancellor of the Exchequer, He was Chancellor of the Exchequer in the early 1930s. He became Prime Minister in 1936 and was Prime Minister until 1940, succeeded by Winston Churchill. And Neville Chamberlain is remembered, unfortunately, for the deal with Hitler in 1938 in Munich. But the great jewel of his career, the greatest thing he ever did, was to convert 5% more than 3.5%, which saved the taxpayer a bunch of money. It's a very rare event, a conversion. So but it's been paying £3.50 or £3.10 shillings, if you like, every year since Neville Chamberlain converted it. Before that, it was paying £5. And look at its, over the year, its value has yo-yoed between £93.90, a max, and a low of £79.12. So you can see war loan is much more variable. Yeah? The longer to maturity, the more variable the price. And the closer to maturity, the less variable. And the last column says the amount in million pounds. So war loan, there's only a couple of billion of war loan. That's not very much. But it was an awful lot in 1918. And you'll see a huge amount. And there's a lot more of it now. The 12 billion is the quantity for Treasury 4.5s. Now let's look down. Do you see CN 9%, LN 11? You see that? Fifth entry? I'll translate that from gobbledygook. CN stands for consolidation. 9%. It was a loan issued when rates of interest were much, much higher, maybe 30 years ago. And it was a very long-term bond when issued, and it's going to be redeemed in 2011. And it's interesting to see that its price is over par. Can we explain why its price is so high? It's a really expensive bond. It's almost the most expensive in all the list. Why is it so expensive to buy? It's £117.45p. That isn't a mistake. Why is it so expensive? What's it going to be redeemed for in 2011, 4 years' time? Only the £100. No. Hello, sir. It's going to be converted. It's going to be redeemed at £100. The reason why it's so expensive. 9% means that it's paying interest of £9 a year until it redeems. So all these bonds are dirty. They're carrying redemption promise plus interest. And the interest on the 9 is double what the interest was on the 4.5. That's why it's so expensive. It's a claim on £9 in the next 12 months, £9 in the 12 months after that, £9 in the 12 months after that, £9 in the 12 months after that, and then £100 in 4 years' time. When you add up that, without discounting, 4 lots of 9 and 1 of 100 would be 136. And then when you discount, and the rate of interest at which is discounted is 4.8, then it gives you slightly less than the 07 one, then it gives you the present value of 170.5. Yeah. Why is the discount rate 4.8? Well, the discount rate is, I'm going to simplify a little bit. I'm going to assume that you have £9 on the 1st of November 07, another one on the 1st of November 08. I don't know the actual date at which these dividends are paid, and there are generally 2 a year. So I've got to simplify. 1, 11, 09, 1, 11, 10, and let's say one more, 1, 11, 11, £9, £9, £9, so I now have 5, and then redemption on 1, 11, 11. and 100. What I do, in order to calculate that 4.8, I've made some assumptions to make it simple. I say this is divided by 1 plus x, where x is the gross annual redemption yield. This is divided, because it's 2 years' time, by 1 plus x squared. This is divided by 1 plus x cubed, because it's 3 years away. This by 1 plus x to the 4th. And the last two terms by 1 plus x to the 5. I equate this with the current market price, which is what? 117 points? What was it? 45. And I solve for x. And x is going to be around 0.048. Makes sense, huh? And actually, we need a bit more information. We need to know actually the date of redemption in 2011. It could be January, it could be December, it'll be specified. We need to know the dates of the payment of coupon, the £9, which are probably in 2 equal lots, maybe one on January the 1st, one on July the 1st, for example. And then the powers are not like 1, 2, 3, 4, but something slightly more complicated. Okay? That's how it, but the interesting thing is that the gross redemption yield here is 4.8. Is that less or more than the gross redemption yield on, it's less than the 5.01, yeah? On the 1 year bond, it's just about to mature, less. That's my fun. Now, why don't I just spend a moment or two looking at a little technical feature. Most people in Britain pay income tax. And most bonds in Britain, tax is deducted at source. Bonds like this £9 one, okay, the one with £9 coupons, is it attractive for taxpayers, especially high rate taxpayers? Is it an attractive asset? No, because that movie £9 is going to be clobbered by a 40% tax rate. Not at all attractive to rich individuals who pay tax in Britain. What about the Sultan of Brunei? Does he pay tax in Britain? No. What about charities? University of Birmingham. It's a charity. Most of its capital is in buildings. It might have 1 or 2 of these. Does it pay income tax? No. What about students who study at 315? Or are studying at 315? Not who have studied, but who are studying at 315. Who pay income tax? Now, of course, I'm very sorry. We all know that universities are expensive and you don't have assets to pay. But if you did, if you were to have assets to pay with, this £9 bond would be a really quite attractive thing to hold until you start working at a large salary, and then it's not worth it. So this bond, this £9 heavy coupon bond, is very attractive to the Sultan of Brunei and overseas people who pay tax, to charities like University of Birmingham, and to people who don't have yet big tax bills. Possibly retired, poor retired people maybe, children, students, unemployed. These are the people who you would say this is not to buy. Whereas if you are a top-rate taxpayer, as most bondholders will be, then these high coupon bonds you won't into the large fund. And you will like, if you're a rich guy with a high tax bracket, what asset are you going to like on this list? That's going to be a really nice one. One with low coupon. Yeah? Because the coupon faces 40% tax. Capital gains, no tax on the coupon. Usually no tax, very low. Forget about it. So you want nice redemption, and low coupon. So if you're a high rate taxpayer, which you soon will be, let's say, in Britain, those of you working in Britain, a few years' time, many of you are going to be top rate taxpayer, 40% of the margin. What bonds do you want to buy on this list? What has a low coupon? Well, the first one has a low coupon. Can you do better than that? Wallen 3, yes, it's 3.5, but it's true, it has relatively low coupon. But what about the Treasury 4.25, or the Treasury 4.25 in 2055? They're only 4.25, or Treasury's 4% 2016s. You see them? That's halfway down. You see the 16s? Yeah. Does the redemption yield look high? No, it looks quite low. So you've got one maturing in 2015 with a redemption yield of 4.55. That carries a coupon of 4.75. Then you have a Treasury 4 maturing a year later, carrying 4.5 on redemption yield, lower redemption yield. Who's going to be buying that Treasury 16s? High tax rate payers, high margin tax rate payers. That's why the price is quite high. That's why the yield is quite low. It's attractive to those people. So there are funny little features about the bond market, like that tax effect. But ignoring that, what is the take-home message from this table? The take-home message is that the redemption yield, as you go up to the future, has got a downward slope on that day. Rates of interest on the longest dated bond, right out to 2055, not maturing for 49 years, carries an interest rate redemption yield of 3.76. That's much, much lower than the bonds to mature in the next year or two, the top two, whose yields are 5, or even slightly above. So, the maturity structure, the term structure of interest rates is a downward slope. What does that tell us if we believe the expectations theory of the term structure of interest rates? It tells us that people expect short-term rates of interest to come down. Long-term bond yields give you a kind of average. So let's go back to that 2016. That's maturing in 10 years' time. 4.51 is more or less the average of 1 year rates of interest expected for this year and for the other 9 years after that, approximately, according to the expectation theory of the term structure. So, if the current 1 year yield is 5, then people are expecting 1 year yields on average around 2010, 2011, 2012 and beyond, a bit less, about 4.3, lower than that. So why are they expecting interest rates to drop? There can be two reasons, essentially. One reason is that we may think inflation is higher now than it will be later. Is that plausible? What's inflation been pushed up by in the last year or two? Oil. Does the market expect these high oil prices to stick? On the whole, people think that oil won't jump again, might even slide a tiny bit. Already it's slipped back a bit. And the general inflation, the big oil price jump from trebling roughly of oil prices over the last 3 years, people think, well, that'll pass, and we'll be back to the 2% inflation rate. Thanks very much. It's very difficult, I'm sorry, to have more than one conversation in the room. If you've got a question, please ask. I have said that to you before. Twice before, if not more. The rate of inflation now is over the 2% band. We're now expecting rates of inflation perhaps to stick on average close to the 2% target. So that's one idea. Another idea is that we may expect real interest rates to come down. Why might that be true? Let me give you some reasons. What do we know about life expectation in Britain, Japan, Germany, Italy, Canada, Australia, China, India? What's happening to life expectation? It's increasing. In Britain, life expectation life expectation is increasing by about a month and a half each year. So if you're younger by a year, you have your life expectation from birth is something like a month and a half above something earlier. It's really increasing fast. What does increased life expectation imply if you don't care too much about your kids? It means you've got to save more for your return. Either you have to or your pension fund has to. And what is the effect of more saving on interest rates? That's one effect. Higher life expectation is unfortunately not evident for males in Russia. That's what could be. And it's not true, tragically, for some parts of Africa, where AIDS is a terrible scourge. But not all parts of Africa, and in Europe and Asia, by and large, life expectations increasing, and increasing even in America, where it's been relatively low, despite a huge amount spent on health. So that's an important effect. Another effect: what's happening to the birth rate, the number of babies mums have in Europe, especially, and in Japan and China? What's happened in the last 30 years? We know. Done. What does slower population growth imply for long-term real interest rates? Probably slower. Another thing we know is that technical progress rates for many economies, especially Germany, Japan, Italy, France, especially those four, but not just for those four, seem to be weaker than they were expected to be in the past. That's another third factor for reducing real interest rates. If we look into the future, we're a little bit pessimistic about technical progress. We think that the fertility, number of children per mum, is going to continue low or possibly even fall further, and life expectation will stay high and rise further, then real interest rates are going to fall. Now let's take a look at index-linked bonds, just to the right. And I want us to look at the issue of what about the redemption yield on those things? Is it associated with time? Now let's look at index-linked bonds. These index-linked bonds, index-linked. Do you see FTSE indexed UK gilt indices, the bottom table? Yeah? Index-linked bonds. Now, can we work out from here the redemption yield? Unfortunately, it's quite. Here's real yield. Yeah, do you see the real yield figures? Just below that table, the bottom almost chopped off by the Xerox. Do you see the numbers there? Real yield on an assumption, say, of zero inflation. 2.28 for index-linked bonds maturing of up to 5 years from now. Over 5 years, 1.22. Wow. What a difference. And if you're expecting inflation of 5%, very likely it'll be 2%, but if it were 5%, what's true about the real redemption yields between bonds maturing within the next 5 years and those more than that? And a huge gap, 1.54 is against 1.05. So what is the market expecting according to these numbers? The market's expecting real interest rates to fall. Long-term real interest rates, is exactly what an index bond will give you. Long-term real interest rates seem to be quite a bit below medium-term to short-term real interest rates. That's evident from those numbers. So, lowering inflation and falling real interest rates are probably the main combination with the two things, which probably explains why the yield curve has got a downward slope at the moment. Okay, was that useful? Everybody happy with that? Okay, so we'll now go back, if we may, to the diagram, which you've got. No, you forgot it. There you are. I'm afraid I haven't got many. I've just got one or two.
What is it? Is it the one with all the arrows? It's Graham.
Yeah, I haven't got many. Who here never got one? Never. Okay.
Oh, that me.
I haven't got very many. Okay. No, you can share. You have it already. You have it. You should never ask for another. Very scarce.